Hello friends, today I am going to discuss the most popular category of stocks in the stock market, that is small cap stocks. This category has a make or break relationship with investors. It can make you rich in the short term, at the same time it can destroy all your capital quickly, which is why it is considered as the most riskiest category in the stock markets, especially for beginners. So, to help investors, we have curated a model portfolio of best small cap companies which are selected on the basis of some key financial factors and future growth outlooks. This will help you to select best small cap stocks for your portfolio. So, what is small cap? It is a term that consists of companies which are neither large cap nor mid caps. Small caps fall below the market capitalization of approximately rupees 5,000 crore. This capitalization can change with a change in the company's market valuation. Market capitalization refers to the market value of a company's outstanding number of shares available in the market. However, the classification is also subject to a company's rank in the benchmark indices such as Sensex and Nifty. For instance, companies which are listed from 251st and 500 in the Nifty index are generally considered small cap companies. Nifty also has a benchmark small cap index in India called the Nifty Small Cap 50, which hosts the top 50 traded small cap securities in the market. Now, why small cap is important? One should know that every large cap or mid cap company was once a small cap company, and the one who grows their businesses and sustains its profits, only those can graduate and step up the ladder from small to mid cap or large cap company. Most of the small cap companies have low revenues and small number of employees as compared to bigger companies. However, these companies have high potential for growth, and at the same time they also carry higher risk. Mostly aggressive and high risk tolerant investors are attracted towards small cap companies in the hope of earning higher returns. Now we will look at some key factors an investors should look at before adding small caps to their portfolio. First up, financial strength. This is one of the key criteria which investors should look at before investing in any company for that matter. Generally, small cap companies do not have as much sales as large cap companies or mid cap companies. But if the company's balance sheet is stable with decent cash flows and low debt, these companies can relatively survive and do better against their peers. For example, as you can see, all our model portfolio companies have been maintaining low debt and stable liquidity ratios like current ratio and quick ratios. So, no matter what the size of the business is, it is important to invest in financially stable companies combined with high potential to grow in the future. Second one is top line and bottom line growth. It is also important to check the past performance of small cap companies. These companies should have a decent track record in at least last 5 years. For instance, check the company's last 5 years sales and profit CAGR growth and compare the same with its peers. For example, all our model portfolio companies have recorded consistently higher sales and profit CAGR growth. IEX Limited has reported 15% CAGR growth in its profits due to its monopolistic gas exchange business, and Thyrocare Technologies, being in a competitive business, has posted a 15% CAGR growth in its profits. So, select such companies which gives high CAGR growth in at least 3 or 5 years. This will give you an idea as to how that particular company has performed consistently. A company which grows its sales and profits consistently eventually provides better returns to investors. Thirdly, market size and positioning. Generally, small cap companies are single product or single service line companies. It is important to know the overall market size of the business a company is operating in, and also the presence of that company in that market. This will give you a broad outlook on the positioning of the company in the market size of its business. A niche positioning in the market or some entry barriers can make a significant difference to the company's valuations. For example, Indian Exchange Limited is also into energy exchange business and has a competitive advantage over its peers due to its niche product offerings and monopoly status. High margins and low leverage businesses. An investor who wants to consistently earn high returns should look for companies which are in high operating margin businesses. Operating profit margin is a profitability ratio which shows how well the company's operations translate into profitability. For example, Indian Energy Exchange and Thyrocare Technologies has been maintaining consistently high operating profit margins. Also, with such a high margins, both the companies are zero debt companies, which is like a cherry on the cake for an investor. Finally, management quality and sound corporate governance. In every company, its management plays a crucial role in deciding the company's future. For before investing in a small cap company, it is better to scrutinize its management history and any possible red flags in corporate governance. As we see, many companies fall prey to such poor corporate governance. Avoid those companies which are facing legal or regulatory battles. Small cap companies tend to get overwhelmed by such regulatory challenges, and it is best to avoid such cases. Lastly, watch out for the latest management commentaries to get valuable insights for the company's near and long term growth. However, small cap companies face certain risks too. Firstly, value traps. Value trap is when a company is consistently operating in lower profits with very limited cash flows and cannot break through the phase while investors wait for them to turn profitable one day. Small cap companies, especially the low ranking ones, are more prone to being value traps and might go bankrupt if the trend continues for a longer period. So, investors are advised to stay away from such value traps. Secondly, stay away from small caps facing regulatory changes as well. And lastly, market cycle. A small cap company's exceptional performance can be a result of a high up cycle. A small cap company grows at an exponential phase in this upcycle, which can also be called as financial bubble. And hence, it is important to find the market cycle in which the particular company lies before investing in its stock. Investors should always keep certain large caps along with small caps to diversify the risk in their portfolios. Thank you, and I hope this video helps you select the right small cap stocks for your portfolio.